I want you to picture this. You walk into a movie theater, right?
Okay.
But instead of one film playing, there are like two completely different movies projected right over each other onto the exact same screen.
Sounds pretty chaotic.
It is a total mess. Because on the left side of the screen, you've got this intense, gritty war documentary going on. You know, secret military casualties, international trade routes under attack, literally massive physical storms rolling in.
Right.
But then on the right side of the screen, it's an absolute party. Champagne is popping, people are cheering, massive corporations are just celebrating these record profits.
It's a real split-screen reality right now.
Exactly. And that is what we are unpacking today. We're doing a deep dive into a stack of news from the July 21st, 2026 Daily Tech Reader. Our mission today is to figure out why the stock market is throwing a massive party while the physical world is kind of, well, catching fire, and what this huge contradiction actually means for your portfolio and really your safety.
Yeah, but before we pull these threads apart, I think we really need to establish the rules of engagement for today's discussion.
Yes, a very vital point. The sources we're diving into today, they contain some highly politically charged developments.
Very much so.
We're talking active geopolitical conflicts involving the U.S. and Iran, the Trump administration's diplomatic maneuvers, massive domestic antitrust battles led by Democratic attorneys general. And we want to be crystal clear with you here. Neither of us is taking a political stance today.
None at all.
Right. Our sole objective is to impartially report the factual viewpoints contained in our source material. We aren't endorsing any policies. We aren't endorsing any politicians. We are just here to give you the unvarnished reality of what is happening on the board so you can make informed decisions.
Yeah, we are analyzing the game, not playing in it.
Exactly. So let's get right into the left side of that movie screen, starting with the most pressing global news. Because, I mean, international instability always sets the baseline for the global economy, right?
Absolutely. It's the foundation.
And in the Middle East right now, Qatar and Pakistan have floated a 10-day ceasefire proposal to Washington and Tehran.
But it's not really gaining traction, is it?
No, not at all. The White House is aggressively downplaying any acceptance. President Trump is reportedly remaining focused on making Iran pay for Memorandum of Understanding violations. So essentially, Iran breached previous diplomatic pacts, and the administration just isn't buying this new off-ramp.
And, you know, the physical evidence on the ground really supports that skepticism. Because while these ceasefire proposals are sort of floating in the ether, Iran's Islamic Revolutionary Guard Corps just struck 2 Greek-owned tankers in the Strait of Hormuz.
Just totally brazen.
Yeah, and they're claiming the vessels were non-compliant.
It's an incredible escalation. I mean, the UK Maritime Trade Operations confirmed that a crew literally had to abandon their ship in lifeboats after a projectile strike.
What?
Yeah, and this comes right after 2 other tankers were hit off the coasts of Oman and the UAE. But here is the piece of the puzzle that really, I think, changes the picture. The New York Times just dropped a bombshell report.
Oh, this is the Pentagon story.
Yes. They reported that the Pentagon concealed dozens of U.S. military personnel who were wounded, along with damaged helicopters, during 3 Iranian strikes on American forces in Jordan.
Right, and the timing there is crucial.
Exactly, because these concealed casualties happened prior to the fatal Friday attack that killed 2 U.S. soldiers.
Which just fundamentally alters the public timeline of this entire conflict.
It does. And it leads me to this theory. I mean, if the situation is escalating this rapidly and you've got the Pentagon actively hiding casualties, it seems to me that mediators floating a 10-day ceasefire are just, it's like someone offering you a handshake while kicking your shins under the table.
That's a good way to put it.
I mean, ING strategists are calling the ceasefire a long shot, but I'd call it a total smokescreen while both sides just prepare for the inevitable, especially considering Lebanese President Joseph Aoun was just hosted by Trump in the Oval Office.
First visit by a Lebanese head of state in, what, 17 years?
Yeah, since 2009. And Trump is pledging major help. He noted he'd speak with Hezbollah if Aoun requested it, all while the Lebanese army enters a pilot withdrawal zone in southern Lebanon. The whole board is shifting for war, not peace.
Right, but the diplomatic theater you're describing, it actually serves a very specific mechanical purpose.
Really? Like what?
Well, the concealment of those initial casualties by the Pentagon, that is a classic escalation management tool.
Okay.
When a government hides military casualties, they're usually attempting to prevent public outrage from forcing their hand into a massive, irreversible military retaliation. They try to keep the temperature down, you know, to manage the response on their own timeline.
Ah, I see. But once it leaks.
Exactly. Once that information leaks to the New York Times, the strategy just evaporates. The leak forces a hardline public stance, which explains the White House rhetoric about making Iran pay.
Because they can't look like they're just ignoring wounded American troops.
Precisely. And this level of regional unpredictability, it's the ultimate nightmare for global markets because it isn't happening in a vacuum. It is happening in the Strait of Hormuz, which is literally the physical jugular of global energy trade.
Which means the geopolitical chaos doesn't just stay in the Middle East. That disruption flows directly into the physical energy market and eventually right to your wallet at the gas pump.
Without a doubt.
I mean, traffic in the Strait is at a near standstill. Rystad Energy is warning that a Houthi naval blockade puts 2.5 million barrels per day of Saudi oil at risk.
And just to put that in perspective for a second, removing 2.5 million barrels a day from a tightly optimized global supply chain is like removing a load-bearing wall from a house.
Yeah, and the foundation of that house is already cracking because Brent crude just hit $90.66, which is up 1.6%, and WTI rose to $83.80. The national gas average is sitting at $4.01 a gallon.
Ouch.
Right. But here's where the data gets genuinely terrifying. While energy costs are spiking like this, the domestic labor market is rapidly cooling off.
The ADP data.
Yes, the ADP data just dropped, showing private sector hiring slowed to an average of just 16,500 jobs per week through July 4th.
Which is a huge drop.
A massive drop. That's down from over 24,000 just a few weeks prior. And it marks a fourth consecutive week of deceleration. So wait, we have a rapidly cooling labor market on one hand, but oil is spiking above $90 on the other.
Yeah.
That sounds to me like a textbook recipe for 1970s-style stagflation, economic stagnation combined with high inflation. Are we about to see long-term inflation become entirely unanchored?
Well, stagflation is the exact scenario central bankers dread most, because their toolkit fundamentally breaks down.
How so?
Think about it. If inflation is high, a central bank usually raises interest rates to cool the economy, right? Right. But if the labor market is already stalling out, like that ADP data suggests, raising rates will trigger a massive recession and massive job losses.
Oh, I see.
But conversely, if they try to save the job market by lowering rates, that $90 oil will just drive inflation into the stratosphere.
It's a complete lose-lose scenario.
It is. But to answer your question about whether inflation is actually becoming unanchored in the minds of the people moving the money, we are about to get a definitive answer.
The bond auctions.
Yes. The Treasury is holding a $13 billion 20-year bond auction on Wednesday, followed by a $21 billion TPS auction on Thursday.
And TPS being Treasury inflation-protected securities.
Right. And these auctions, they serve as a literal lie detector test for the global financial system.
Okay, break that down for me. Why a lie detector test?
Because TPS are unique. The principal amount you are owed adjusts upward based on the consumer price index.
Yep.
So if inflation goes up, the value of your bond goes up. Investors can go on financial news networks and say they aren't worried about inflation all day long, But when they have to lock up billions of dollars for 20 years, their true fears are revealed.
Ah, put your money where your mouth is.
Exactly. If investors aggressively demand these TIP S over regular bonds, it is their money admitting they believe inflation is going to devour their returns over the next 2 decades. The bond market is watching that $90 oil and that cooling labor data, and the yield on these auctions will reveal the exact level of institutional panic.
Wow. But the crazy thing is, if we look over at Wall Street, specifically the stock market, it seems like they are wearing noise-canceling headphones, just blasting their own euphoric playlist to drown out all these geopolitical sirens.
It really does feel that way.
I mean, the equity markets are completely ignoring the stagflation threat. The S&P 500, the NASDAQ, and the Dow all just snapped a 3-day losing streak.
Yeah, the Dow jumped 385 points.
Right. And the S&P is tracking a 24.7% earnings growth rate year over year. That is the second consecutive quarter above 20% and the 7th straight quarter of double-digit growth. 88% of reporting companies have beaten their earnings per share estimates.
The dissonance is jarring, I agree. But if you look at who is actually leading that charge, a very clear psychological pattern emerges.
Well, it's the old school legacy giants, right? General Motors just beat their estimates with an earnings per share of $3.57.
Right.
That's the actual profit generated per share of stock, and it drove a 30% profit jump for the company. And they didn't do it with, futuristic tech. They did it through good old-fashioned North American truck and SUV strength, which, by the way, helped mask their ongoing electric vehicle losses.
Exactly.
And then you have 3M, the company making tangible things like tape and industrial adhesives. They jumped 7% after beating estimates and actually raising their full-year guidance.
Yeah, and what you are seeing there is capital-fleeing speculative promises and rushing toward tangible cash flow. When the macro environment is this scary, investors want to see a product they can touch and a profit margin that clears the bank today.
Which brings us to the ultimate test of speculative promises, AI monetization week.
Here we go.
Yeah. Chip stocks surged. NVIDIA was up 2%. The broader semiconductor index rebounded. But we have IBM reporting Wednesday at 5 p.m. trying to recover from a recent 25% single-day crash.
That crash was brutal.
It was. Then Alphabet and Tesla report Wednesday evening, and Intel follows on Thursday. Look, Wall Street is demanding immediate dominance everywhere else. It seems to me that with these reports, the tech sector finally has to prove that AI isn't just this bottomless money pit of research and development.
Well, the grace period for big tech is officially over.
You think so?
Oh, definitely. Over the last several quarters, companies like Alphabet, Tesla, and Intel have poured just astronomical amounts of capital expenditure, CapEx, into artificial intelligence infrastructure.
Just billions and billions.
Right. They're buying the chips, they're building the massive data centers, they're training the models, and for a while, investors gave them a pass on these massive costs because the theoretical future value of AI was just so incredibly high.
Right, but borrowing money isn't free anymore, and investors actually want a return on that investment now.
They want to see it on the balance sheet as actual revenue. Wall Street is no longer going to be satisfied with a shiny press release about a new language model or abstract promises of future efficiency.
No more hype.
Exactly.
Yeah.
They need to see how the billions spent on AI are translating into software subscriptions, higher margins, or concrete product sales today. IBM's recent 25% crash, that is the canary in the coal mine.
Oh, that makes sense.
It shows exactly what happens when a tech giant stumbles on that promise. If Alphabet or Tesla fail to demonstrate that AI is generating real, measurable revenue this week, those noise-canceling headphones will come right off, and the reality of the macro environment will crash into the tech sector.
And you know, that demand for immediate, tangible dominance, it isn't just happening in tech. It's tearing apart every major sector right now as companies fight over what the future actually looks like.
Yeah, the corporate brawls right now are intense.
They really are. We're seeing massive fights centered entirely around this friction between legacy models and future promises. Let's start with healthcare. Novo Nordisk just sued Eli Lilly over GLP-1 patents.
Ah, the weight loss drugs.
Yes, these are the revolutionary hormone-mimicking drugs driving the massive weight loss craze. This lawsuit opens a brand new legal front in a billion-dollar war, as both giants look beyond their current blockbuster drugs, semaglutide and tirzepatide.
And this isn't just a fight over a diet pill,
Right, it's way bigger than that.
GLP-1 drugs have the potential to fundamentally alter the baseline costs of global healthcare by mitigating downstream obesity-related diseases like diabetes and heart disease.
So whoever controls those patents basically controls the future economics of the medical industry.
The stakes are just astronomical.
They really are, and we see that same tension between legacy and future, just totally paralyzing the media industry right now. The $111 billion Paramount-Warner Bros. Merger is currently frozen in absolute limbo by a 14-day temporary restraining order.
Yeah, that lawsuit is fascinating.
It is. 12 Democratic attorneys general are pursuing an antitrust case, even though the Department of Justice already approved the deal. So the traditional studios are completely on edge, basically just trying to consolidate to survive.
Right.
But meanwhile, Netflix, the supposed king of the new streaming era, is trading at a 52-week low. They're down 12% pre-earnings with no real data catalyst expected until October.
It is a very severe reality check for the economics of streaming.
Well, compare that to traditional sports broadcasting. Fox Sports just confirmed a massive 60.3 million viewers for the 2026 World Cup final.
60 million, that's absurd.
It is. That tournament delivered 7 of the 10 most-watched soccer broadcasts in U.S. history. Fox and Telemundo are taking that leverage and immediately opening rights talks with FIFA for 2030.
So I have a theory here.
Let's hear it. It seems to me that Netflix is tanking because they are trapped on a content treadmill. They simply cannot afford, spending billions to acquire customers who just churn out a month later. Whereas Fox just proved that live sports are the only thing immune to the algorithm. So is legacy TV actually winning the war?
I would say legacy TV is winning the most important battle, which is the battle for simultaneous attention.
Simultaneous attention.
Yes. The streaming model is a war of attrition. As you noted, the customer acquisition cost is incredibly high, and the churn is constant. You sign up, you binge the show, and you cancel.
Right.
But what Fox Sports proved at the World Cup is the undeniable unifying power of live event sports. In a fragmented media landscape where everyone is, siloed in their own personalized TikTok or Netflix algorithm, live sports are the last remaining cultural water cooler.
That's a great point. You can't binge watch a live World Cup final 3 weeks later.
Exactly. You have to be there right then, experiencing it with 60 million other people. Advertisers know this, which is why traditional broadcasters hold historic leverage right now. While the studios are paralyzed in legal limbo over a merger, Fox is securing the future by doubling down on the ultimate legacy product, a live game.
Even if the game itself was a bit messy, frankly.
Yeah, that final was intense.
FIFA just scheduled a disciplinary hearing for Argentina's Leandro Paredes after a post-final altercation. And the Argentine Football Association is still defending Coach Scaloni, despite them producing basically zero offensive threat, literally 0 shots, and 0.2 expected goals in the first half of that final.
Which is pretty shocking for Argentina.
Right. And, perhaps signaling the true end of an era, Lionel Messi's agent dropped a heavy hint about his retirement, confirming no commitment beyond the 2027 Copa America defense.
It's a passing of the torch in the sport, right? As the broadcasting of it reaches its absolute zenith in the U.S.
Yeah, exactly. But look, we need to take a massive step back for a second. We've spent all this time talking about billions of dollars in abstract value, right? AI monetization, bond yields, media rights, geopolitical chess.
Yeah.
But none of that matters if the physical infrastructure underpinning it all is just washed away.
As they say, the physical world always bats last.
It really does. Billions of people are dealing with actual, literal forces of nature that are disrupting daily life and commerce right now. Tropical storm Bertha is currently 110 miles south of Panama City, packing 50-mile-per-hour winds.
It's moving fast.
It is. It's expected to make landfall Wednesday near the Louisiana-Mississippi border, threatening the Gulf Coast with flash floods, up to 4 feet of storm surge, and isolated tornadoes in the Florida Big Bend region.
Serious threat.
And further up the map, a cold front pushing east from the Ohio Valley is driving an enhanced severe storm threat for the mid-Atlantic and Northeast on Wednesday, bringing damaging wind and hail.
Though that front will provide a heat break for the interior Northeast, right?
Yes, it will, but the southeast interior remains stuck under severe heat advisories, with heat indices hitting 100 to 105 degrees.
So when we talk about global trade being squeezed by military conflict in the Middle East, how do these localized weather events compound that supply chain chaos?
Well, it really reveals the profound fragility of how we have structured the modern economy.
What do you mean by that?
We talk about supply chains as if they are abstract lines on a spreadsheet, right? But they are fundamentally physical things. They are oil refineries on the Gulf Coast. They are highways in the Mid-Atlantic. They're regional power grids.
Very true.
And over the last 3 decades, corporations have heavily optimized these supply chains for maximum efficiency, which is known as just-in-time logistics.
Meaning they don't keep excess inventory sitting in warehouses because it costs too much money to just hold it.
Exactly. They removed all the slack from the system to boost those earnings per share we discussed earlier. So when a localized event like a 4-foot storm surge from Tropical Storm Bertha hits the Gulf Coast, it doesn't just damage homes, right? It physically paralyzes local labor.
Yes, it floods the roads those GM trucks use. It shuts down regional energy infrastructure. You have a global system that is already choking because 2.5 million barrels of oil are trapped behind a blockade in the Strait of Hormuz.
Right.
When you add a localized weather event that takes a regional port or a refinery offline, that deeply optimized system simply snaps.
It's a cascading failure.
It is. The abstraction of the stock market relies entirely on the stability of the physical world.
Which brings us perfectly back to the split-screen reality we started with today. I mean, we are living in a moment defined by an incredible juxtaposition. On one side of the screen, you have an explosive geopolitical landscape where concealed casualties and tanker strikes are pushing us toward conflict, compounded by severe physical storms bearing down on fragile domestic infrastructure. And on the exact same screen, you have a roaring stock market, buoyed by the tangible profits of old-school legacy giants, and the desperate hope that artificial intelligence will reinvent the economy. It is a world that is simultaneously breaking down and breaking records.
It is a profound contradiction to navigate. And, as you digest all of this, I want to leave you with a final thought to mull over.
Let's hear it.
We spent a significant amount of time today discussing the billions upon billions of dollars being poured into artificial intelligence to optimize our software, our data, and our corporate futures.
Right.
But if a single geopolitical strike in a desert strait or a single tropical storm surge on the Gulf Coast can paralyze our physical supply chains and energy grids overnight, does all the artificial intelligence in the world actually make our society more robust?
Sure.
Or does it just make us more efficiently fragile?
Man, that is the defining question of this decade. The movie is playing, and we are all in the theater together. Thank you so much for joining us on this deep dive into the Daily Tech Reader. Keep questioning the headlines, keep looking at both sides of the screen, and we will catch you next time.